Hello traders, and welcome to another video. So in this video we are going to talk about market structure. Okay, so importance of market structure. I'm going to show you guys a different types of market structure. We are gonna dig deep into them, talk about them more. I'm gonna show you a few examples of them, and yeah, I'm gonna really show you what is high probability, where should you get involved in trade in terms of market structure, when the market structure is really messy and you should be thinking more about protecting your capital and staying away from it. So yeah, let's get into it. So I'm going to draw a few different types of market structure right now, guys. So the first type of market structure that we have is bullish market structure. So when you are looking at the bullish market structure, you guys want to see, first of all, impulsive break of structure here, and you want to see impulsive break of structure here. You guys want to see momentum right here, and you guys want to see momentum right here, momentum right here as well. So guys, this is a perfect example of a bullish market structure. So price action is moving to the upside, retracing, giving us a pullback, then impulsively breaking this previous high with momentum, and then continuing to go to upside. Again, pushing above, we have a pullback, and again, impulsive break of structure and momentum. Okay, guys, so this is basically an example of bullish market structure. So this is where you want to get involved in the market, and this is where you're gonna have the most high probability trades. So when price action is again moving to the upside, making this a retrace, pullback, breaking this high right here impulsively, and then after every momentum, after every impulse, there is a pullback again, and then again you want to see this bullish momentum breaking this high, and then if you want to trade based on this demand zone right here, guys, this pullback and continuation for again the break of structure and momentum, this is where your trades are going to be high probability, when there is a trend in the market, when there is a bullish market structure. So again, guys, market structure is like basically like this: price action breaking above with the impulse, pullback, breaking above, making you high. It's important that this momentum, this leg right here, is impulsive and full with momentum, and that it takes this previous high impulsively, and then again a pullback, and then again the same thing. This is where your trades are going to be high probability. The same thing to the downside, guys. Bearish market structure, there is a momentum involved, you know, a price starts to pull back, again we take this low impulsively, again after a new lower low, price makes a new lower low, again we see a pullback, again we break this low impulsively, and this is where you're gonna have your high probability trades, when the structure is bullish or bearish, but there is momentum involved in the market. Okay, guys, so there's another type of market structure, and that is sideways trend. Okay, so you're gonna see the price action is going sideways. So usually when price action is moving sideways, there is no clear direction in the market. So bearish momentum is present, and at the same time bullish momentum is present. So there are equal buyers and sellers in the market. So price action is showing us indecision in the market, and it's a never good thing to trade in this kinds of market. Yes, you can trade, you can have some good trades, but again, overall, if you want to stay more safe, and if you want to have more high probability trades, you have more confidence and more advantage, guys, on your side, you should be avoiding sideways trend. Again, price action is making liquidity here, price action is making liquidity here, and you actually never know what price action is going to do. Is price action going to push up, take this liquidity, and then push down to take this liquidity? You know, it's really manipulative. This trend is sideways, and in some previous lessons we talked about what retail traders are doing wrong. So when they win, they win small, and when they lose big. So basically, if you want to be on the right side of the market, and if you want to have a good mindset, when you win, you should win big, and when you lose, you should lose small. There are traders who are trading sideways trend, and believe me, you're not gonna have as much high probability and as much high risk reward trades if you're trading sideways trend. For example, let's say that this was impulse to the upside, this was a pullback, and this was impulse to the upside. Price broke this high, and then you should consider this demand to take the trades from. And then price action is gonna go to the upside, go down on break even, go up to upside. This is the single thing that I hate the most when I enter the trade. Okay, so I enter the trade, and then price goes in profit 4%, comes back to 2%, comes back 3%, comes back to break even, and then I'm in a trade for a long period of time, and I'm like, either take me out or go in profit. You know, don't range in between my entry and a little bit profit. So I hate that. This is the single most the thing that I really actually do hate when trading. So basically, you're not gonna have, you know, as much risk reward here, because price is gonna range. You know, it's gonna go in profit, break even, go in profit, break, and you're not gonna have those high risk reward trades that you're looking for. So when you win big. You know, so when you see corrective market sideways trend, you should stay away from it. Okay, guys, and there is another market structure that is we call it ascending price action. Okay, so you're gonna see the smaller ones and the bigger ones as well. So you're gonna see the price action is doing the same thing, making new higher high, retracing, making new higher high, retracing, making new higher highs, retracing, making new higher highs. But what is the difference here between ascending price action and, you know, bullish trend, bullish market structure, is that we do not have impulsive breakouts. Okay, so price is more or less is ascending to the upside with no momentum. So when we broke these highs, we do not break it with momentum, and it is not indicating to us that price wants to trend to the upside. There is, you know, momentum involved to the upside, because after we break the high, there is weakness, and we immediately retrace, and we immediately retrace, and we immediately retrace. Okay, so there are certain pairs that like more to go from this ascending right now to the upside. You know, for example, your USD, and there are certain pairs that like to do this. You know, ascending price action, then impulse to the upside, continues to the downside. AUD USD is a perfect example of that. I like to trade this kind of entries on AUD USD. You know, this is showing me weakness to the upside, and then a smaller one, then boom, reversal on AUD USD play really good. So basically, guys, this is everything that you need to know. You know, difference between a market structure that is bullish, that breaks these highs, you want to get involved in it, and, you know, ascending price action when price is in a clear uptrend, but we do not get that much momentum, you know, in the market with a standing trend, and also there is a sideways trend. And when there is a sideways trend, when there is a corrective market, you want to stay away from it. You do not want to trade it. Okay, guys? So I'm going to show you a couple of examples right now of different kinds of price action, and you can guess what type of price action is this. Yes, this is a bullish market structure, guys. So this is where you want to get involved in the market. So as you guys can see, after this change of character here, price started to pull back to the upside. So how do we break this high? Impulsively. Look at this beautiful momentum to the upside. How price is breaking with this bullish momentum to the upside. Even here you can see how price is breaking above. Okay, how price is breaking above. And then again we have a retrace. Look at this bullish momentum to the upside. And again, how do we break? With bullish momentum to the upside. Again, guys, how do we break this high? Bullish momentum to the upside. How do we break this high? Bullish momentum to the upside. So there is a bullish momentum involved in the market, and we are taking out these previous highs impulsively. Okay, so this is a clear example of bullish market structure and bullish trend in a market. This is where you want to get involved in the market, because you can take advantage of it. There is more confirmations that price is most likely going to trend. So there is no point in trading something like this for reversal when price action is clearly reacting to this order block, and price action is most likely going to take out this order block. As you guys know, this is GJ, so we talk about this in pair characteristics video. This is GJ and it likes to do this, you know, and then a fake out to downside and boom, continuation to the upside. It keeps going up. So this is the same example right here, you know, how traders are getting trapped here. Even this corrective approach was really corrective of building liquidity on the way up. You know, there were a lot of traders who are thinking that this is, you know, break of structure, change of character, downside, momentum, and they want to get involved here to take their shorts, you know, but there is a clear trend in the market. Price is clearly reacting to this inside bar candle order block here, and is clearly doing what this pair likes to do the most, and that's fake outs, trap and fake outs, trap and fake outs. This is DJ. All the JPY pairs are like that, full of fake outs. So again, guys, this is example how you should not go against the trend when there is a trend involved, and you should take buy opportunities when there is a trend involved. This is where you want to take advantage of that current trend, because market is bullish, market is showing you momentum, there are more confirmations, and your entries will be safer when there is this kind of market structure. Okay, so there's another market structure that is bearish market structure. Again, guys, look at this beautiful descending price action. Clearly price action is breaking below impulsively. How we're taking these lows here, guys? Impulsively. How we're taking this, guys? Impulsively. How we're taking this, guys? Impulsively. So this is where you want to get involved in market. You know, when price action is making this, this was a one candle breakout, so not as beautiful. But again, impulse to downside, retrace, impulse to downside, and then reaction from this for continuation push down. This is basically your confirmation when you want to enter the trade. You know, this would be your execution entry here, and you have on your side bearish market structure. You see how price action is taking these lows. It's breaking them impulsively. There is momentum involved to the downside, and you know that you want to take advantage of it. So this is really good, you know, because you have direction on your side, you have structure on your side, you have that bearish flow on your side. So this is the example of bearish market structure. Again, guys, price breaking below, you have a retrace, impulsive break of structure. So this is really important that we take this low impulsively, and then again pull back, we take it impulsively, and then again pull back, we take it impulsively. So this is example of bearish market structure. Okay, guys, the next example we have up, yeah. So in this example, guys, we can see that we have this longer ascending price action. So this is again JPY loves to do this. Again, guy, I explained this on pair characteristics video. So you're gonna have this ascending price action, you're gonna have fake out, and all the traders here are gonna sell on this supply. There breakout retest traders who are gonna sell on this here. There are breakout traders who are gonna immediately sell after this, and then price is first gonna take breakout traders, it's gonna take breakout the retest traders, it's gonna take this smart money traders, and price action is going to continue to go in this ascending. And then again, the same thing is going to happen, and then the same move. It's going to take breakout traders, breakout retest traders, supply and demand traders, and then it's again going to continue to this ascending price action. So this is the pair characteristics of Euro JPY, and I have talked about this in pair characteristics video. But again, guys, how you can spot the difference between bullish market structure when there is a momentum involved and ascending price action. So how we're breaking highs? No momentum in the market. What happens after we break the high? We immediately break the high, retrace, break the high, retrace, break the high, retrace. Again, fake out. Look at this fake out. Boom to the downside, change of character. Breakout traders are trading this trend line liquidity, this trend line, breakout of the trend line. They're breakout retest traders who are trading this right here. They're even double top traders here. There's supply and demand traders here. Boom. Prices continue to the upside. The same thing happens here. 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 A lot of cases, you know, because this is JPY pair. So price is going to move in this ascending for long periods of time. But there is no momentum when we break. And this is how the trader gets trapped, because they see weakness to the upside. But again, price action, how we're breaking the highs, how we're breaking the highs, how are we breaking the highs, how we're breaking the highs, how we're breaking the highs. What happens immediately after we break the highs? Immediately retrace. So this is example of longer ascending price action when the trend is not that much involved in the market. So price action is moving. This, for example, is impulsive. As you guys can see, this is impulsive breakout of this. Then we have a pullback, and then what we have right now, again, boom, impulse to the upside. Where is our demand? Right here. Look at how good this trade was. Boom to the upside. You have, you know, confluence of ascending price action, longer trend, ascending trend. So you do not need to rush when you see something like this. When there are no trades, do not rush. Wait for high probability entry. You're gonna have it like this. Okay, so you're gonna have ascending price action on your side. You're gonna have this fake out on your side, trapping all the traders. Where are here traders selling? Because we again know this is JPY. It likes to give us a fake outs. Where are the traders selling? On this supply right here. What happens to that supply right now? The supply was taken. So I talked about this pattern in the characteristics video. You're gonna have this ascending price action. You're gonna have this breakout, and then you're gonna have this boom, and then you want to see something like this breakout, and you want to trade something like this here. So you want to trade this. This is the same example of that pattern right here, guys. So basically, you know, supply to demand flip, demand in control, boom, price action, making this liquidity on the way up. You know, we're taking this high impulsively. You know, it's really a beautiful example. So how, you know, retail traders are getting trapped, and then boom, price action is continuing to the upside. So this is example of ascending price action. So do not rush when you see something like this, because you do not have enough confluence if you want to trade for long positions. You know, wait for that impulsive break of structure, and price action is showing us that it's breaking above impulsively. Again, breaking above impulsively. This is where you're gonna trade, and this is where you're gonna find high probability entries. And there is a impulsive break of structure, and there is a momentum in this impulse. Okay, so ascending price action basically is showing us weakness. Again, moving in this ascending price action, we're breaking the highs, retracing, breaking the highs, retracing, breaking the highs, retracing, breaking the highs, retracing. There is no momentum in the market. Okay, there is no momentum, and price is showing us weakness, and price action can easily continue to the downside. Okay, so there is a sideways trend again as well, guys, and this is where you should totally stay away from the market. When you see price action like this, when you see price action making this ascending, descending, ascending, descending, ascending price action, it usually indicates a bigger range. When you see price action like that, and price action makes this ascending and then descending, you know, something like this, it's a usual indication that the price action is going to continue to be corrective. And they're really, this is the kind of market that is tricky, really, really tricky. Price action is building liquidity to the downside, building liquidity to the upside. And you never know what's going to happen. Okay, you're going to trade based on this demand. Let's say, for example, price is going to continue to the upside, but it's going to react from this, and it's going to take your stop loss. Okay, and then there are traders who are going to sell here, price is going to take their stop loss. And there are traders who are going to sell here or buy here. It's going to, you know, it's going to be a little bit profit, loss, a little bit profit, loss, a little bit. You cannot catch those high risk reward trades. There is no confluence when there is momentum in the market, you know, there is impulse in the market, and then you take your trade and it goes and it goes and it goes and it goes like crazy. You have your advantage, you know, because you were trading with a trend, and you know, sky is the limit. Price action can go, and you can just manage your trade and enjoy your profits. Here you cannot do that. Why? Because price action is gonna make this a standing it's gonna make this sideways price action, and it's gonna be like, you know, price action moving up, moving down, reacting to this demand, reacting to this supply, demand, and eventually it's going to take all of them. It's going to take all of them. Okay, so look at this price action taking all of them to the upside, you know, taking their stop losses, whoever sold here, and then boom, taking their taking also buyers, taking first sellers, taking buyers. So it's manipulative, you know, and you cannot win big risk reward trades. Your trades are going to be risky. So when you see price action like this, that is corrective in sideways, just avoid it. Do not bother. Okay, guys. So that's basically it for this video. So just basic things about market structure, so you guys know what you should look at, what you should ignore, when is the right time to be more aggressive and take advantage of the market, and yeah, of course, when is the right time to be more passive, play defensively, and protect your capital. So yeah, that's it for this video, guys. Again, if something is not clear to you, just shoot us a DM and we are going to be more than happy to reply. Hope you learned something new, hope you enjoyed the video, and yeah, see you in the next one.